The price of trust, how LIBOR taught the world to lie about money. 1. The illusion of simplicity. For decades, global finance revolved around one number most people had never heard of, LIBOR. It sounded harmless, even elegant, the rate banks charged each other to borrow money. Every morning, the biggest banks guessed what they'd pay if they borrowed that day, and someone averaged the guesses. That average became the benchmark for everything: mortgages, student loans, credit cards, and government debt. So what does that actually mean? It means your mortgage rate was set by a global guessing game run on the honor system. Footnote. This section introduces LIBOR as the central but fundamentally trust-based benchmark in global finance. 2. The perfect crime of polite people. LIBOR worked on trust, and trust, in banking, is just another word for opportunity. A few traders realized that nudging the number up or down by a fraction could move billions. A single text, "Hey, can you lowball LIBOR today?" was enough to shift global markets. It was like letting students grade their own exams and then pay bonuses for good scores. The regulators assumed the banks were too big to lie. The banks assumed the regulators were too naive to notice. Everyone was right. Footnote. This section explains how minor manipulations of LIBOR enabled massive profits due to blind trust in self-reporting. 3. The culture of collusion. By the early 2000s, traders weren't just cheating, they were coordinating. Secret chatrooms called the cartel and the mafia became daily meeting spots. They joked about fixing the fix, swapping champagne for favors. This wasn't Ocean's 11, it was office gossip with global consequences. When questioned later, one trader shrugged, "We all did it." And that's the scariest part, he wasn't wrong. Footnote. This section shows how widespread normalization of manipulation turned organized fraud into standard industry practice. 4. When the thermometer lies. In 2008, as the financial system imploded, banks were too scared to lend to one another. But instead of reporting higher borrowing costs, they lied, submitting fake, low numbers to look healthy. The system's heartbeat flatlined, but the monitor said everything was fine. One economist compared it to a thermometer showing 98 degrees while the patient was in cardiac arrest. So what does that actually mean? The world's financial lifeline was already dead, but no one wanted to call the time. Footnote. This section compares LIBOR's falsified rates during the crisis to a deceptive health indicator masking systemic collapse. 5. The Great Unmasking. When whistleblowers exposed the scandal in 2012, it was like catching Santa rigging the stock market. Barclays was the first to confess, handing regulators a treasure trove of emails that read like a sitcom for sociopaths. Other banks soon followed: UBS, Deutsche Bank, JP Morgan, Citigroup, the Royal Bank of Scotland. The result? $9 billion in fines. Sounds like justice, until you realize that's pocket change for banks that made hundreds of billions from the scam. Footnote. This section summarizes the exposure of LIBOR manipulation and highlights the disparity between penalties and profits. 6. The system that taught itself to cheat. The scandal wasn't a one-off. It revealed a system designed to reward deceit as efficiency. The traders didn't hack the system, they were the system. LIBOR was a daily poll of bankers marking their own homework. When honesty is optional and profit is mandatory, you don't get capitalism, you get choreography. Footnote. This section argues that LIBOR's structure made manipulation inevitable because it incentivized dishonesty through self-regulation. 7. Stability over truth. When the crisis hit, regulators faced a choice: expose the full fraud or keep the illusion alive to avoid panic. They chose the illusion. Reports were written, committees formed, fines paid, and everyone went back to work. LIBOR was eventually retired in 2023 and replaced by SOFR, a supposedly cleaner benchmark based on real data. But the same people run the same system with the same incentives. Different name. Same game. Footnote. This section reveals how regulatory responses prioritized market calm over accountability, perpetuating systemic risk. 8. The psychology of profit. At its core, LIBOR wasn't about interest rates, it was about psychology. Fear. Greed. Peer pressure. The need to hit targets. Every manipulated decimal point was powered by human ambition disguised as arithmetic. The victims weren't visible because the theft was microscopic, a few cents here, a few dollars there, multiplied by billions of contracts. Invisible crimes committed in broad daylight. Footnote. This section reframes the scandal as a psychological phenomenon driven by incentives rather than purely financial mechanics. 9. When corruption becomes routine. The genius of systemic corruption is that it hides in normalcy. No guns, no alarms, just spreadsheets. When fraud becomes standardized, it stops being crime and becomes procedure. LIBOR's manipulation didn't feel illegal to its participants, it felt like paperwork. So what does that actually mean? When theft is automated, ethics become obsolete. Footnote. This section examines how normalization of deceit within formal procedures erases the moral awareness of wrongdoing. 10. The legacy of the lie. In the end, LIBOR wasn't just a financial benchmark, it was a global trust experiment, and the experiment failed. The price of money turned out to be the price of belief. The scandal didn't break capitalism, it revealed its reflection, a system where honesty is negotiable and confidence is currency. The world moved on, but the lesson remains, the real risk isn't when people break the rules. It's when they write them. Footnote. This section concludes that the LIBOR scandal exposed trust, not law, as the true foundation and vulnerability of modern finance.